Hi, I'm Kep Kepner, CPA here in Dallas. I'm in a big office building, 25 stories. And in some of this office building, there are some small business owners. Here's my philosophy and my belief. If you walked into those offices on January 1st and you went to the desk of the owner, you would see two stacks of checks. One stack of checks would be all the receipts that they'd received in the latter part of the year, but they haven't put in the bank because they don't want to report those on their taxes. Then on the other side of their desk would be a stack of checks that they have written dated December 31st. Those are all the checks that they want all the expenses to be in their business for this tax year, even though they might not have mailed those checks. Now, can you get away with that? Well, you can get away with that if you're not audited. On the receipt side, the IRS has a term, it's called constructive receipt. That means if you've got the check, it's revenue, whether you put it in the bank or not. So if the IRS were to audit you for a particular year, one of the things they're going to do is they're going to look at your bank statement for the next January. And if you have a bunch of November and early December checks deposited in the first part of January, they're going to say, come on, give me a break. You actually had that money in hand for last year. And they're going to add that back to your revenues and at that point to your profit. They're also going to look at that bank statement and see if most of those checks that you wrote on the 31st of December have cleared the bank. And if they haven't, they're going to say, well, wait a minute, those were really still payables. You really hadn't spent the money. So, like most taxpayers that are on a cash basis, the IRS is smart enough to understand this game. Does this mean you shouldn't do it? Well, the fact of the matter, it goes on. And the IRS isn't stupid either. They know that you got to play the same game next year and the next year and the next year. And eventually, you're going to get caught up. Okay? When I started my business and had a low amount of revenue, I had a lot more incentive to operate that way. As my business has grown more strong and powerful and provides everything that I need, then I find that I have less pressure to do that kind of thing. Now, of course, as a CPA, I have a different kind of pressure because I represent my clients. So it wouldn't be a good idea if the IRS found that I had constructive receipt of all this revenue and had all these checks dated December 31st, and I was playing that game. So I don't play that game. I'm not saying I didn't many years ago, but I don't now. So for you, the business owner, that's one of the strategies that you can implement. You also can implement the strategy of buying equipment that you need. Now, the fact of the matter is, in December, Congress will pass an act that will extend a certain number of tax benefits. One of those is how much you can write off in depreciation on purchases of equipment this year, and whether or not they will allow bonus depreciation. I expect that they will. They did last year, but right now that amount's only $25,000. At the end of last year, they implemented it so it'd be $125,000. So the real bottom line on spending money at the end of the year for tax purposes is to buy only what you need. If you don't need a backhoe for your construction business, why buy it? You may need it next year, buy it next year. But don't use up all your cash buying something you don't need. Oh, it's true, you get a discount in effect. Let's say that you're in the 30% tax bracket and that backhoe costs you $20,000. By writing it off this year, you save $6,000. But you probably have that next year too. So don't ever buy anything just because you can write it off. And also consider this. If you need to buy it by the end of the year to get a better price, that doesn't mean you have to put it in service. So let's say that you need to buy some trailer for your business, and you go to the trailer manufacturer and they say, look, if you buy by December 31st, you can get a 30% discount on this $50,000 trailer. That's 15 grand, okay? Well, you can do that. You can buy it. You can finance it. You can pay cash for it. You can do any of those things. If you don't put it in service until January, then you don't write it off until January or the next calendar year, and you got that 15% discount that the trailer manufacturer was offering you. So be smart about this. Don't just spend money. Spend money only on the things you need. And if you're going to need it in January, you could probably buy it in December. And you could make the decision about when you placed it in service, either in December or January. You could make that decision maybe when you do your tax return in March. Now, think about it. If you buy that trailer and it's still sitting at the dealer's location on December 31st, but you've paid for it, you really haven't put it in service. So the IRS is going to look at these documents if they ever audit you. So there has to be a reason why you bought it and you have access to it, and you either put it in service this year because it was in your possession, or you put it in service next year because you didn't use it until the next year. This is all just solid tax planning. And if you need help doing that, I'll be glad to help you. Give me a call. Thanks.